To the markets now, investors feeling bullish today. In fact, according to Bank of America Merrill Lynch, the aggregate domestic holdings are at the highest since January 15. Domestic investors haven't been this bullish since then. But that optimism could be tempered. The Congressional Budget Office expects U.S. economic growth will probably accelerate this year before slowing in 2019 to well below the Trump administration's 3% target. That according to CBO. So should investors keep riding this rally? Kind of a bull-bear debate going on right now. Michael Scanlon, portfolio manager with Manulife Asset Management, is overweight U.S. equities, while Quint Tatro, the chief investment officer at Joule Financial, is underweight U.S. equities right now. Gee, do I go with the bull or the bear? We'll flip a coin here, Quint. Quint, you've been underweight for a while. Why? Is this as good as it gets, or what else are you looking at right now?
Well, let me preface by saying it's not fun being wrong
yes,
as we are currently. But it started at the beginning of the year when we had an unsustainable rally in January and we took some profits. And then as the year went on, we started to be stopped out of positions. We will set disciplined levels, and we've bounced back from a lot of those levels, but they were breached, and we, by our just don't own disciplined nature, have taken those positions off and have not found places to redeploy. I get especially concerned. I'm not always a contrarian, but I am concerned when I see all of the bullish statistics out there, especially today's report. It's easier for me to be bullish when people are pessimistic.
Okay. Michael, do you feel like you're in a crowded trade right now, still being bullish this market?
Well, whether it's a crowded trade or not, I still feel like it's justified. When you look at the earnings that we just reported this quarter, they were phenomenal. And you look at the data going forward, I think there's really three key drivers that keep us very constructive on U.S. equity markets. And that is the earnings trajectory, which we should be able to maintain from here. The buyback activity at about $1 trillion run rate, which is about 3% of the S&P 500. And then the economic data in the U.S. continues to be very strong. So I think that being overweight U.S. equities continues to be justified relative to the rest of the world.
You know, the footnote to the Bank of America Merrill Lynch investor survey, Michael, is that they favor defensives over cyclicals. So even though fund managers right now are net long by the highest amount since January 2015, there is sort of a defensive tilt that Bank of America Merrill Lynch is recommending. Within your equity overweight, where are you?
So that conclusion there sounds a little bit of a reversion to the mean, right? You've seen some of the sectors like consumer staples underperform to start the year here. For us, we look at it and we're still very exposed to the cyclical sectors. So energy is an overweight for us. Financials is an overweight for us. It really comes down to company-specific stories. But when you look at our sector weights, we are still overweight those cyclical sectors.
What if we suddenly had a trade deal with Mexico? Something like that. Would you become more bullish? I mean, I think it would lead the market to rally, but do you think that would be short-lived, that rally, or would that kind of make you rethink your
So you bring up
an
excellent point, and that is, what will the market do in response to good news? One of the reasons we're so pessimistic, cautious, is that we've seen negativity in the market after positive news. Look at the GDP report, 4.1%. The market sells off. Look at some of the earnings, Caterpillar, this morning's Home Depot. You're seeing these that are already baked in. So my curiosity, I wouldn't run out and be a buyer, but it would be a change in character if that good news came out and we sustained a rally. Does that make sense?
Yeah.
So that would then get me to go, okay, it's not baked in. Now I'm going to look for value. And in that particular instance, I actually would look outside of America to the beaten up emerging market plays, because they have been absolutely pummeled. And if we saw trade agreements and so forth, those areas would rebound.
Very good. Food for thought.
So there is an additional way to get exposure to that market as well, and that is through the mega cap U.S. names, where they're getting 30–40% of their revenues from overseas, and you're not taking that FX risk as a U.S. investor to get exposure to it.